What if one smart decision in 2025 could grow your portfolio for the next decade? Welcome to TFC, Tech and Finance Code, your go-to hub for smart investing and tech insights. If you're planning to invest in the stock market in 2025, this might be the most important video you watch all year. The market is shifting. Interest rates, AI advancements, global energy transitions, and government policy are all converging in ways we've never seen before. Whether you're a dividend-focused investor, a growth chaser, or just getting started, this guide is built for you. We'll cover the most promising stocks to buy now, tailored to different investing goals. From blue-chip giants like Apple and Microsoft to emerging market rockets like Mercado Libre, we've got the full map laid out. And yes, we'll even talk about Elon Musk and how his unpredictable moves affect the entire market. Buckle in. This is your guide to the best stocks to buy in 2025. Let's start with the foundation of any smart portfolio: stocks that offer consistent growth and reliable dividends. First up, Apple Incorporated. Apple is more than just iPhones. It's a full-fledged ecosystem: Macs, iPads, wearables, and services like Apple Music, Apple TV+, and iCloud. What makes Apple special is its unmatched brand loyalty, massive global user base, and a services business that keeps growing every quarter. In fact, Apple is sitting on more than $50 billion in free cash flow and returns a significant portion of it to shareholders through dividends and stock buybacks. If you're looking for a rock-solid stock that won't let you down, Apple is that stock. They've increased dividends since 2012, and the product roadmap, including innovations in wearables and AR with Vision Pro, continues to excite investors. Then we have Microsoft, the other half of this powerhouse pair. Microsoft dominates the business world with its cloud platform, Azure, Office 365 suite, LinkedIn, and its massive investment in OpenAI. Microsoft Teams remains a vital piece of corporate communication infrastructure, and its enterprise clients bring in stable recurring revenue. With consistent dividend increases for over 2 decades and strategic AI integrations across its product line, Microsoft is the quiet juggernaut of both enterprise software and cloud computing. If you want a defensive, cash flow-rich tech stock with AI upside, Microsoft is your go-to. Next, let's talk about Alphabet, the parent company of Google, a stock that combines deep value with explosive AI potential. Alphabet is currently trading at a valuation below most of its big tech peers, making it one of the most attractive long-term buys in the space. Google Search still commands over 90% of the global market, and YouTube continues to expand in both viewership and monetization. But what sets Alphabet apart in 2025 is its push into AI with Gemini, their ChatGPT competitor. Gemini is being baked into every part of their ecosystem: Google Workspace, Gmail, Docs, and even Android. Moreover, Google Cloud is expanding its footprint among Fortune 500 companies, adding a second leg of recurring enterprise revenue to complement ad sales. Behind the scenes, Alphabet also owns some of the most futuristic moonshots out there: Waymo in autonomous driving, DeepMind in AI research, and Verily in healthcare tech. Alphabet is what happens when you combine steady core profits with risky, innovative bets, making it the perfect stock for investors who want safety today and growth tomorrow. Now let's talk about risk. Not every investor wants to play it safe, and that's where high-growth, high-risk stocks come in. Enter Uber Technologies. Uber is no longer just about ride-hailing. It's a logistics giant in disguise. With Uber Eats dominating the food delivery space and Uber Freight targeting the logistics market, the company is diversifying its revenue streams fast. In 2024, Uber achieved GAAP profitability, a huge milestone that signals it's entering a new phase of maturity. At the same time, it's investing in autonomous vehicle partnerships with companies like Waymo and Aurora. As cities continue to urbanize and ride-hailing becomes a necessity, Uber's long-term upside remains massive. Then we shift focus to Mercado Libre, often dubbed the Amazon of Latin America. But it's more than just e-commerce. Mercado Libre controls its own payments platform, Mercado Pago, its own shipping and logistics network, and even consumer credit services, all in one ecosystem. It's growing revenue by more than 30% year over year and is already profitable, which is extremely rare for companies operating in emerging markets. With Latin America's middle class expanding and internet penetration rising, Mercado Libre is perfectly positioned for exponential growth. If you can handle the volatility, this could be a 10x play in your portfolio. Energy isn't going anywhere. In fact, it's becoming more crucial than ever as AI infrastructure demands skyrocket. The data centers powering ChatGPT, Google Bard, and future AI models need enormous amounts of electricity. That's where Chevron and ExxonMobil come in. Chevron is more than just oil. It's an income-generating machine with a 3.9% dividend yield and billions in free cash flow. portfolio. The company is investing heavily in carbon capture, renewable energy, and natural gas, making it a smart bridge between traditional energy and the green future. Their financial discipline and commitment to shareholders make Chevron an excellent defensive pick with AI infrastructure exposure. ExxonMobil, on the other hand, recently completed a massive acquisition of Pioneer Natural Resources, cementing its position as a shale leader. Exxon is one of the most profitable energy firms on the planet. Its investment into lithium extraction, carbon tech, and hydrogen fuels positions it to benefit from the coming shift in global energy policy. If you want stable income while also betting on the infrastructure behind AI, these two companies are your best bet. The stock market doesn't move in isolation. Every investment is tied to government policy, Federal Reserve actions, and, let's be honest, public personalities. In 2025, the Federal Reserve's interest rate decisions will remain a major factor. Lower interest rates can ignite tech growth, while higher rates typically hurt speculative and high-growth stocks. Regulation is another big theme. Alphabet and Apple are under constant antitrust scrutiny in both the US and Europe. These lawsuits could influence how they do business, but they can also create volatility and buying opportunities. Meanwhile, government subsidies like EV tax credits, semiconductor grants, and green energy funding are funneling billions into sectors like chips, clean energy, and electric vehicles. Investors who follow government spending patterns can often front-run entire sectors. Now let's address the elephant or rocket in the room. Elon Musk. Musk isn't just the CEO of Tesla. He's a force of nature in the markets. His tweets can move crypto prices. His AI startup xAI is threatening to disrupt the landscape dominated by OpenAI and Google. His actions in energy, automotive, and AI sectors ripple across dozens of tickers. Watching Musk isn't optional. It's essential. Whether it's Tesla Energy, Starlink, or his recent merger talks, Musk's actions have major influence on stock valuations across tech and energy. Let's check out a real example. In August 2018, Elon Musk shook the stock market with a single tweet claiming he was considering taking Tesla private at $420 and that funding was secured. The news sent Tesla's stock soaring over 11% within hours, triggering a trading halt and widespread investor frenzy. However, it was later revealed the funding wasn't confirmed, prompting an SEC investigation. Musk and Tesla were fined $20 million each, and Musk stepped down as chairman for 3 years. This incident is a prime example of how Musk's words alone can cause massive market movements and regulatory ripples. Let's wrap it up with a quick summary and sample portfolio breakdown. If you're building your 2025 portfolio, here's one way to think about it. For steady growth and dividends, Apple and Microsoft. For value and AI upside, Alphabet. For high-risk, high-reward growth, Uber and Mercado Libre. For income and AI infrastructure, Chevron and ExxonMobil. If you're younger and have time on your side, lean heavier into Alphabet, Uber, and Mercado Libre. If you want passive income and safety, focus on Microsoft, Chevron, and Exxon. Most importantly, stay diversified. Don't chase hype. Watch the macro trends: energy, AI, regulation, and yes, Elon Musk. Thanks for watching TFC, Tech and Finance Code. If this helped you think clearer, invest smarter, or build confidence in your strategy, hit that like button and subscribe. We've got more deep dives coming every week. And remember, invest smart, ignore the noise, and build wealth one decision at a time.